Good morning, I'm Bill Hubard, Chief Economist at Trade.com, and welcome to our weekly market wrap here on Core Finance. And I have the pleasure of talking to the strategist from BGC Partners, Mike Ingram. Well, Mike, I guess after Kim Jong-un, Harvey, and Irma, is there really anything else to talk about in the markets?
Well, I mean, we've got the forthcoming ECB meeting today, haven't we, in terms
Yes,
of...
yes.
Yeah, a couple of hours. Look, Draghi is tiptoeing towards tapering, isn't it? I mean, as I expected.
Is he going to be on Strictly this year? I didn't know.
Strictly?
You said tiptoeing, you know?
Oh, what, is income dancing? I'm not sure. But look, I mean, the way I think this is going to pan out is they will say today that they're tasking various committees to look at the options for implementation after the current program ends at the end of this year. Now, last time this happened was in 2016. The previous program was supposed to have ended in March of this year. In September of last year, they said we're going to have a look at it, and by December of 2016, they said, well, this is what we're going to do. We're going to extend by 9 months, where we're going to reduce from 80 billion euro a month to 60 billion euro a month. And that was presented in, they were saying, well, actually, the monthly amount's gone down, but if you look at the extension, the total amount of QE has gone up. So the market seemed to be reasonably happy with this. Now, I think the time frame might be a little bit more compressed, because obviously...
Let's just put the chart up, okay, as we go on, okay?
Yeah.
Now, as you say, I mean, 12:45 today.
Yeah.
The one thing that I'm hearing and seeing now, away from the politicians talking about the euro being too strong, et cetera, we're starting to see one or two major European banks saying, well, at least give us a hint today that maybe we'll reduce it to 30 billion. So I guess the market really talking today at 1:30 this afternoon, are we at 118, or we're back to 120 on euro dollar?
Yeah. Well, without sounding sort of trite, I mean, they have to taper at some point next year, by mid next year, because if they carry on the current trajectory, by the middle of next year, they are physically going to run into constraints of what they can buy.
Exactly.
Yeah. So I mean, during the existing asset purchase program, they've tweaked it twice as to what they could buy and what price they could buy it at. That will have played out completely within the next 9 months. So it's a question of when it's going to happen, rather than, you know, it's not a Japan QE forever situation. Right. So to answer your question, well, look, I mean, it's not only there's various hints on QE. It's also the update, the autumn forecast from the staff, ECB staff, and there, what you are likely to see, the growth forecast almost certainly will go up. And I think actually, if you look at the inflation outlook, there's a very real chance the inflation outlook this year they'll keep their forecast. Next year, I think they might actually go down. Now that combination,
really?
yeah, because if you look at the, I've got a slide later on, but if you actually look at underlying domestically produced inflationary pressure, it's still very weak. They're making glacial progress towards that 2% target. Most of it's stuff like energy, and of course, the last 3-4 months or so, you've seen a significant appreciation of the euro, and I, of course, would expect Mario Draghi perhaps to quite forcefully talk that down. Now, he hasn't prepared the ground for that. You had rumblings out of the ECB. He didn't do it. He didn't do it at Jackson Hole. I'm just wondering now, though, you've got a lot of positioning, bullish positioning in the euro, lots of calls out there to 6 months. I'm just wondering, and maybe I'm overthinking this, but maybe he's corralled them all up in one place, and then, bam, all of a sudden he's trying to talk down the euro, he's hosing people in those positions, creating a lot of two-way volatility, and that might be a more effective way of getting the euro down than taking a rather more softly approach.
But I guess one of the things, and looking both at the euro, and then now let's look at sterling here. It really is now a move, whether it's euro, sterling, Canadian dollar yesterday with a somewhat surprise from the Bank of Canada. Okay, the second move since July. I mean, I think we're looking at a 2-year low versus the Canadian dollar. It's a situation where, it really is almost, no matter what currency you're in, it's sell the dollar, period. Now, here, it's a question of, we got the leaked document yesterday, compliments of The Guardian about, immigrant flow in and out of the United Kingdom over the next couple of years. Also, the simple fact is that, you know, we're hovering around that 130 level. Is that much too strong for the Bank of England's liking?
Too strong for the Bank of England. I don't think so. I mean, I think that the potential dilemma for them is that the pound takes another big step down at a point in time where the economy is clearly slowing. I mean, you booked 0.2% quarter on quarter in the Q1, 0.3 in Q2. You're going to do no better than 0.3 in the current quarter, Q3. And I think overall the growth forecasts from the Bank of England and perhaps even the market itself have to come down.
Because, I mean, I guess most of the people I talk to forget the charts of this, that, and the other. But this is the trend they're looking at. We're talking here the 128 towards 125 near term. Near term could be tomorrow or 6 months from now, okay?
Yeah.
And I mean, even looking at what you're saying, looking at the CFTC data, as you said about the call position in Eurodollars, I mean, we've reduced the massive shorts in sterling as it hovers around 130. But I mean, there is still the talk, and as we can remember at the most recent Bank of England meeting, okay, I think only Nomura, and I did have lunch with my good friend George Buckley, the UK economist at Nomura last week.
Right.
And we were all laughing about it, but I always have to agree with him. I mean, what's wrong with raising rates from 0.25, which is the lowest since 1690, to 0.5, okay? I mean, the Bank of Canada basically inferred that. And again, you know, with what's happened in the States, I mean, the market now is proposing less than a 30% probability that the Federal Reserve will raise rates in December. Well, I mean, I could see this if rates were at 14, 15, 16%. But I mean, we're at almost single-digit numbers.
Yeah, well, look, I mean, I guess we're breeding almost an entire generation now of financial market commentators that have never seen an interest rate increase, or at least not seen rates which were close to zero. Look, I mean, I made it very clear at the time, August last year, that cutting rates by 0.25% from the Bank of England was a policy error. You know, there was no economic crisis to tackle at the time, and the numbers that came in from the real economy borne that out. Now at the moment, we're going through an economic slowdown, but you know, I've characterized this, and I think I said this back in January of this year, it's a slow puncher rather than a comprehensive implosion. Yes, consumer sentiment is somewhat fragile, I think, but as long as the employment numbers are ticking over at a reasonable rate.
What are we at, 42-year low, okay? I mean, here in the UK. I mean, it's a simple fact is, how low can it go? Now, let me just look at dollar yen, and this is quite interesting because yesterday, towards the end, as we were all ready to go home, we all of a sudden saw dollar yen fall to like 108.80. Now, for some people who may not know, can we blame that on the Stanley Fischer effect? And what did Stanley Fischer do yesterday?
Well, Stanley Fischer, so he's the vice chair at the Fed. He was due to end his term in June of next year, and he said for personal reasons, whatever that might be, that he would leave on around, I think, October 13th.
Yeah.
So he's kind of been seen to cut and run. And look, he's 73 years old, so, you know.
There's nothing wrong with 73 years old.
Ask me in a few years' time, Bill. Touched a raw nerve there, clearly. But look, I mean, it's the number of seats now which will become available on that board of governors, which are permanent voters, has just gone from 4 of 7 to 5 of 7 once Janet Yellen almost certainly goes.
Okay, that's my next question.
Oh, yeah.
Okay? Because he did say in his, you know, the Janet Yellen and I were, you know, best buddies, and we thought alike. And Janet Yellen said she felt that she had a real, quote, soul brother, and these are my words, on the Federal Reserve. Now, again, it looks like probably as early as this afternoon, I think, is Randall Quarles is the guy that Trump, and also I got a very interesting email this morning, a client basically saying that, you know, Gary Cohn, who'd been sort of heads-on, his feeling was after his comments in reference to Charlottesville, the only chair he's going to get could be the electric chair rather than a Fed chair. So do you think maybe this could be a conspiracy saying, okay, Stanley, we flip. You go first and I'll announce mine, or, you know, later.
Right, you've opened a lot of doors there. Okay, so try and get them through them really quickly. For a start, I think Janet's out. I don't think she wants to be there.
I was going to say
I don't think she wants the
yes,
job.
I agree.
I mean, it reminds me of Ben Bernanke, you know, getting grayer and grayer, and you know, before the Senate and so forth. It's like he does not want to be there. He wants to go back into his, you know, into his professorial office and do empirical research and so on. Great, and I think that's kind of where she is. You know, if she wanted to pitch for her mandate being renewed next year, she probably shouldn't given the speech she did at Jackson Hole.
I was very surprised.
Yeah, I mean, look, we're dealing with a White House which has politicized pretty much everything. So whatever she was going to say was always going to be framed in a political. In a political way, but she gave them so much ammunition. So it was a full-throated defence of the regulatory. And of course, Randy Quarles, who I think is going before the Senate Banking Committee today to be confirmed.
I think so. I mean, that's what we're talking.
I mean, his background is Wall Street. He's ex-Carlyle, you know, private equity. He's a deregulation guy. That's not going to be a happy relationship. You know, say Stanley Fischer, major support for Janet Yellen. He's going, you know, she's not going to cut and run. She's not going to go before January.
Of course not.
But you know, and in terms of who might replace her, you mentioned Gary Cohn. Well, he was very critical of Trump post Charlottesville. So again, you know, and I don't think he wants the job anyway.
I would agree.
So again, the question is who might want to take the job and who might take the other Fed chair seats, which are already. I mean, this is assuming that Randy Quarles gets elected. This is the thing. You've got a pretty dovish FOMC at the moment. Yeah.
Is this what the president wants? A weaker dollar?
Which day of the week are we?
Which tweet are we looking at?
Well, when he was candidate Trump, yeah, then the Fed was all part of the Democratic, you know, Obama conspiracy to keep rates artificially low, and it was creating financial distortions and so on and so forth. Now that he's in office, he likes what a surprise. He likes low interest rates, and he likes a weaker dollar. Well, he's certainly got.
Well, going back to the comment you made earlier, ahead of the ECB,
yes.
You know, you got your slide here on the inflation head fake.
Yes.
Now, explain that to some of our viewers.
Right. So the red line is the headline CPI, Consumer Price Index, and that's the one that the European Central Bank officially targets, and their target is close to, but just below 2%. Right, let's just say 2% for shorthand, because, you know, and you can see on this chart, and this goes back to, well, it goes back 5 years, yeah? It's been a long time since they've been anywhere close to that target. But there was a bit of an excitement at the start of the year because it actually popped up to that 2% level at the start of the year. Yeah, you see that there. And since it's come back and it's meandered a little bit. But we've got these other measures of inflation, because economists love to construct these indices to prove anything they want to prove. They say, well, let's put an index together to prove the point I'm trying to make. If you strip out a lot of volatile elements, which is driving that red line, and I'm thinking primarily about things like energy, oil prices, gas prices, prices for metals and things like that, which has obviously seen an enormous variation over the course of those 5 years. If you strip some of those more volatile elements and to get back to something like a core inflation number. So you've got, for instance, you've got that blue line, which is Eurozone core CPI. And that strips out energy. It strips out a lot of fun things like tobacco and alcohol. Stuff that people don't buy, obviously. Then you can see, a lot of that volatility is stripped out. But of course, you've also got generally a much lower number. And there you've got, instead of 1.5 for the headline CPI, you've got 1.2.
Well, you got one last slide.
Yes.
Let's look at this quickly, okay?
Yeah, all I'm pointing out, and I mentioned energy being a major element, and there I looked at the Thomson Reuters core commodity index, and I transposed it. It's a dollar index. I transposed it into euros. Okay. Now we know the euro's been very, very strong thus far this year, and all I've looked at is the year-on-year change in that index in euros to give a feel for whether commodity prices as a whole are a headwind or a tailwind for the inflation number. And what it tells you, and again, it matches up with that sort of ramp up we saw in headline inflation at the start of this year within the first quarter. And you saw that on a year-on-year basis, commodity price inflation in euros was running at 30+%. It's now at -8, -9%. And if everything stays where it is, if the euro stays with it, if commodity prices broadly stay where they are, that will continue to be a headwind for another 6 to 9 months.
Well, last question here, okay? We got 30 seconds.
Yes.
12:45 today.
Yes.
Draghi postpones everything to mid-October and says, thank you very much. Have a nice September. And Merkel, good luck with the election, and we'll discuss this again in October.
Yeah, I think so. I mean, I would. The only thing I'd add to that is I think 12:45. Obviously, we'll just get the rate decision, etc., which will be no change. It's really the presser 45 minutes later at 1:30, which is going to be the issue. The statement coming out there. But yeah, other than that, I think it'll be whether or not he chooses to talk down that euro, because I say there's some very crowded positions at the moment. They could easily get hosed, and I'm just wondering whether this might be part of a deliberate strategy.
Well, on that positive note, Mike, thank you very much for joining us, and we'll see you very soon. Thank you very much, and we will see you next week.